Hello, everyone. Welcome to the weekly roundup. Today we will cover interest rates, inflation, and market sentiments. Hello, Ben.
Hi, Eva.
Nice looking weather behind you.
I see that little Canada flag right here and the Peace Tower over here.
We should frame this picture. Very
That's it.
Canadian.
Exactly. I feel patriotic.
Yeah. Oh, okay, we're gonna start off with some economic data. So Canada's GDP contracted more than expected last quarter, and the manufacturing PMI has been negative for the most part of this year. What does this mean for interest rate decisions, and is the slowdown here to stay?
Yeah, so thanks. Yeah, it's a good question. I mean, I think PMI, which is the manufacturing index that come down, you'd expect that should help pull down inflationary pressures as well in Canada. And so, my kind of our base case coming into this last quarter was we expected three cuts from the Bank of Canada, and now we're probably looking at two cuts. I'm a little surprised given what you just referenced. GDP is slow, PMI is slow, inflation's got to be slower too, unemployment's rising. So it doesn't, I can't balance that a little super well because the Canadian economy is slowing. We saw a slight positive today uptick with our exports were a little bit better to the US last month than the previous 6 months. So that was a slight uptick, but we still think rates come down. If our economy continues to slow like this, then we still think rates continue to move lower in Canada.
Okay. Speaking on inflation, recent trends in both the US and the Eurozone have shown persistent price pressure. Could this also influence the Feds and the ECB to
Mm.
do something different in terms of interest rate decisions?
Yeah, so a few things on that. Certainly, we had Jackson Hole over the not too distant past, and they were talking a lot about this inflation targeting, starting to be a flexible inflation targeting, something like that, which gives them a bit more flexibility to cut into an inflationary uptick. I think that there's a bit of a recency bias, right? We went through COVID, and so we expect, inflation could take off and we're at 10, 15% again before we know it. I think that is an anomaly. And looking back, probably 20 years from now, you're going to see that as just a blip in the radar. So I don't think there's a giant risk to the upside there, at least in the US. The tariffs could potentially continue to keep pressure up. So obviously, the country that's charging the tariffs, if the companies decide to pass that through to the consumer, then there's pressure to the upside from an inflation perspective. But you're seeing unemployment start to rise and their economy slow. So I think Powell is going to take into account that. As for Europe, I saw a speech from Christine Lagarde last week, or a couple of days ago at least, talking about the many challenges that they have in Europe, as there's challenges in every country. But one of the things that she talked about there is just the scale at which the non-financial sector is taking over the banking sector there. And it's making it a bit more difficult to see what the economic activity is like, because the data is not as consistent as prevalent because money's flowing into different financial institutions. So I think it's a continues to be challenging for the world central bankers as the system's changing so dramatically. So I think you'll see the central bankers try to move more to this, we'll say, giving them flexibility to cut even into an inflationary environment, because ultimately they don't have much choice. And if they want the economy to continue to go, then they need to make financial conditions easier.
Yeah, so we've seen the central banks juggle inflation, growth, job numbers. What's the likely tipping point for their decisions? What should we be focused on?
Yeah, so I think, well, there's been so much focus on that CPI the last couple of years, at least the last 2.5 years. I think that becomes less relevant now, and I think we should be looking at the GDP and unemployment numbers more. And so I'd be watching those two. And if we continue to see unemployment rise, the other side of that is slowing economic activity. And so I'd be looking at those two things as well. I'd be looking at financial conditions. Are they getting easier or harder? And probably the last piece would just be you'd start to look at, do defaults, are they starting to kick up in certain areas, autos, credit cards, things like that, to say at if and how they're deteriorating. But I'd say, unemployment and GDP, probably the key economic ones to look at.
Okay. Let's just go into the market a bit.
Mm-hmm.
Historically, September has been a challenging month for the equity markets.
Yeah.
What contributes to this volatility, and how can an investor position themselves for the potential bumps ahead?
It's true. September can be and has been. So we got September 11th coming up, obviously next week,
Yeah.
and so that was a big, obviously dramatic event in the world, but also caused a lot of anxiety in the financial system because markets were closed for a couple of days at that point. But September tends to be a time where I want to say everybody comes back to work, but the financial system tends to wake up again. And so you get everybody back into trading, paying attention, more activity, volumes start to pick up. We've had a pretty good start to the year from an economy perspective and market perspective. And so as everyone comes back to work, things start to, I guess, could kick up and move dramatically in one direction or the other. And so how I'd be thinking about it is from a preparation perspective is, if you've had a good year to date and your portfolios have performed quite well, like ours have, we'd be looking to take advantage of either reducing risk some way, either selling, trimming, buying insurance through puts or something like that. And the third piece would be, which we've talked about a few times now, is bonds. And so if you've been catching the headlines, as I'm sure you have, like US and in Europe, you're starting to see those bond rates, at least on the long end, up around that 5% level. And so you look at UK gilts, the 30 years are up around 5, and everyone seems to be in a panic mode that this can only go higher from here. I'd be in the opposite camp of that, where I'd say government intervention, either via central bank or the fiscal authorities, will be making changes to try to keep that level muted. And so, in a market correction, if you're buying 5%, 4 or 5% bonds, you're going to get some protection as money flows into safety if we saw a crack in the market. So, I think trimming and or buying insurance and some bonds can put you in a position to reduce some of that risk that you have right now, where I'm starting to get calls about everyone wanting to take more risk. Clients are thinking that everything goes up all the time. These are good kind of soft feelers to indicate that we're probably closer to the end of the immediate run that we've had than the beginning of it. I don't think it's over now, but I do think that being cautious and making some wise risk management decisions is key right now.
Okay, makes sense. Let's see the charts.
All right. Okay, just let me know when you can see it.
Loading. All good.
Okay, perfect. Yep, so we are recording this around 1 o'clock on September 4th. So anything that happens between now and the end of the week, we'll comment on, of course, next week. I'll add a couple comments around what we see happening tomorrow after we get through the charts today. So great. Some interesting things to look at. There's a lot of talk just about debt and deficits and such. I think there's a general feeling that the U.S. is spending all this money and Canada is much more fiscally responsible. I'd say that's not necessarily the case, but Canada is different from a perspective is we issue debt as a country, but also the provincial governments issues a tremendous amount of debt as well, which is quite different than the US, where the majority of their issuance is from the federal level. So we would be in a similar bucket category. We've issued more bonds in the last quarter than we did in a very long time, something around 144 billion, which was a 28% increase year over year. So We certainly have debt issues in both Canada and the US, but part of the reason why I think you see some kind of management of the yield curve at some point, not saying it's happening tomorrow, the next day, or the next week, but at some point you would likely see some type of action that pulls down the long end of the yield curve. Because if you're in a position where you can push rates down, that helps the government and it helps the economy. So, big debt levels, both Canada and the US, and pretty much any developed market in the world. So one of the things that's happened, certainly in Canada the last 5 years, is the amount of international market funding that's been helping us. So this is starting to be a bit of a concern for me, actually. So, lots of questions just around the resiliency of the Canadian dollar here, what's going on, how is that possible? We've had lots of international investors buying into Canada, Canadian bonds, and that has been supporting not only the Canadian bond market, but also the Canadian dollar. So this would be a place of concern for me that I'd be paying attention to right now. But for the most part, right now, foreign investors have been buying in Canadian bonds from a perspective of looking to diversify what they own, and maybe some of that's away from the U.S. dollar. So that's an interesting piece to pay attention to as well. So as I look around the world, we continue to talk about EVs or electric vehicles, and electrification of everything continues. And there hasn't and isn't a lot of copper mines out there in the world, but this is a great snapshot of Ivanhoe Electric. Ivanhoe Electric is building a copper mine in Arizona right now, and have a project in Saudi Arabia as well. But and Saudi and the U.S. have obviously very good relationships. But if you're looking to potentially be in a place that is, I'd say, friendly for mining, but also friendly for the future development, being in the U.S., developing a copper mine is a pretty interesting idea that I think we should be conscious of. So this is Ivanhoe Electric, tickers IE, something to watch as things progress from here. And then again on the yield curve. So as I mentioned a couple of times just on our conversation here, where I could see the yield curve start to come down. And right now we'd say we have a natural yield curve, a little bit of inversion on the short end in the US, which is on the top line certainly here, as you see. But then further out, we got a natural curve. In Canada, we have a natural curve. So the one thing that the governments kind of do at times, where Bernanke did back in the old days, is he would sell the short-dated stuff and buy the long-dated to flatten out the curve, so Operation Twist. So I think we could see some of that likely to happen in North America ahead, as they want to push down that long end to reduce the pressure both on individuals and on governments. And so that would be something I'd be watching here. Prime rate, so overnight rate, as we mentioned at the top here, you got the Fed's rate at 4.25 to 4.5. We are, at least the market right now on September 17th is anticipating a 97.6% chance of a cut. And so I'd expect we see that cut on September 17th. And then if we look at the next two meetings after that, we're looking at, October and December. October is only about a coin toss right now, 50% chance. December is similar, 90%, and 45% chance of two cuts. So we'll be watching those numbers, and those will be contingent, as I mentioned, on unemployment and GDP. I expect as we move forward from here. And then in the Canadian market, we start to see rates come down. As I mentioned off the top, we thought 75 basis points earlier. Now it looks like 50 basis points before the end of the year here. So interesting, continue to watch the curve. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. If you have any questions, certainly at any time, please feel free to reach out to your advisor or to ourselves, and we're happy to answer any questions. And not all of the things we discussed today fit your risk profile, so happy to answer any of those questions if need be at that time.
Thank you, Ben.
Welcome.
What's on the agenda for next week?
So there's a few things, well, certainly tomorrow as well. I think we have non-farm in the US, and we have Canadian unemployment numbers and PMI numbers in Canada as well tomorrow. And then fast forward a week from today, we get jobless numbers and CPI in the U.S. So those will be interesting, important points. As I mentioned, it's all but baked in for a rate cut and by the FOMC on the 17th. So I don't think there'll be too much to happen between now and then, except for whatever future cut's going to look like. Canada right now, we're a coin toss or so whether they cut this month. And so tomorrow's numbers could be relevant. And so we can comment and update on that next week. I'd be looking to see what happens to markets because we've had gold touch new highs, as you know. They had, we'll say, I posted that chart last week, right, about the breakouts, and the gold bugs are happy and all of this, and we saw 52-week highs on miners this week. So, I continue to watch that. We have exposure to gold and silver, either directly with companies or with the bullion, and so we're spending a lot of time seeing what do we do with it. And I feel like a broken record a bit from perspective of my challenge is more from perspective is what do we switch into? How do we take some profits and switch into something else? And so that continues to be a bit of a challenge, but energy, oil and gas is looking a little bit more attractive. So there could be an opportunity there. So be watching that, but the gold and gold miners continuing to run will be something that I'll be watching here quite closely.
Yeah, sounds good. Thank you, everyone, for listening. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial Heartbeat newsletters will be in the caption of this video and will be in your inbox as well. For our clients, reach out to me if you have any questions or if you'd like to book a meeting with Ben. Thank you, everyone, and have a great weekend after you get through Friday.
Thanks, everybody.
Bye.
Take care. Bye.